So, without further ado, I would like to hand over to Lee Cowshaw, who is going to facilitate our guest speaker of today with Andy. Thanks, Lee.
Thank you. Thanks, Julie. Okay, so today's first part of our session, as Julie said, we're going to be doing a closed open mic at the end after a short break. So today's session, I'm delighted to welcome Andy Day from Capital A, Capital, not Capita A. So the objective and the reason that we put this session together was really following on from the HBA Business Leaders meeting that most of you attended a couple of weeks ago. And the feedback that we received from that, but also the engagement of your businesses and the state of the industry. This session has been created and designed with Andy to really help to provide you with toolkits, the kind of know-how opportunities, and looking at new futures and new ventures if that's where you want to kind of progress and diversify businesses into. So the audience, as we know, and obviously just chatting with Andy, is that there is a mixture of our members from an agency perspective in terms of what you offer. So there are venue finding agencies on here, event management, creative agencies, a mixture and a blend of both, accommodation provider agencies as well. And from a recommendation for Andy, Andy, I mean, I'll introduce Andy and talk about his own business, but Capital A kind of sell and buy creative agencies, but also help agencies to drive forward through acquisition, diversification, and specializing in private companies, PLCs, larger, small, family-run agencies as well. So a real collective mixture, and we felt it was quite a mirror image of kind of the diverse makeup of members that we have within the HBAA. So Andy, as an introduction to you, and just before I hand over to Andy, if you do have any questions, please do put them in the chat, and we will get to them, if not through the session, certainly as a follow-up. But we want this session to be as kind of interactive as possible with Andy. So Andy, first of all, handing over, you'll be pleased to know, everybody, that we haven't got slides. It's not death by PowerPoint. This is really more about an open discussion from pre-prepared questions that we've worked through, and kind of, as I say, from the feedback from the business leaders meeting we had a couple of weeks ago. Andy, why your interest in our industry, our sector that we are all passionate about? So business accommodation, business events, meetings, creative agencies. Why and what is your background in that, please?
So yeah, my background is really in the media industry. So I was working in newspapers, and then I went into video and started working at MTV in the early noughties. And then I went on to work in the music industry more. But after that, I set up my own music website, which became one of the most well-known websites, I would hope, music websites in the UK. And out of that, a website called Gigwise, depending on whether you're into music or not. And out of that business grew a quite big digital publishing business. And as part of that, we sold gig tickets, we create content, we put on events. You know, we had quite a sort of broad thing that we did that was within that. And we grew that to a fairly large size. And 2016, we exited the business. Actually raised a bit of money first, and then sold the business. Yeah, did a full exit. And after that, what happened was some people started approaching me and saying, we're really interested in the sort of business that you sold. Could you help us to find similar businesses? So that's really where I got my introduction to M&A for other people. And so I started looking for other businesses to acquire. And as I did that, I built up the buy-side clients. Obviously, we were approaching companies that were interested in selling, and I started to build up the sell-side clients as well. One of my early clients was a company called Cheerful 21st. I don't know if you've heard of those guys, but they're part of a bigger business, a small PLC called Arima Communications PLC. So they're an events company, and they put on fairly large events, conferences, etc. And very, very creative agency. So I've been working with them as well to look at acquiring lots of different types of events, industry businesses, which has included event management, venue finding, and all the sorts of things that around the MICE industry. So I don't have a very specific interest just in this area, but our sort of specialism covers right across creative agencies, and that includes the event industry as well as content creation, digital, brand design. It's all the way across really. And so most of the businesses we work with have creative leaders and creative founders that head the business. And because my background is creative as well, my role really is to interpret what accountants and lawyers and other people say during the M&A process, and kind of, sort of bridge that gap between the two skills, really. So we've done some work with events companies, and certainly I did a similar webinar with MiceBook, I think, and that's possibly how we got the introduction as well.
Okay, and you just talked there about a business owner that's sold successfully. How would your approach have differed if you were looking to sell or buy during a pandemic or on the back of one? When is the right time? Because right now businesses have changed. Some businesses have changed beyond what they started out to. Some of them obviously have diversified into other areas and will continue on that path as well. What kind of, what's the difference now in terms of the back of a pandemic or during a pandemic? What's kind of changed, and what is the right time for that approach to whether it's a merger or an acquisition?
Yeah, I mean, every situation is very unique. So even the pandemic obviously brings different variables to the table, but each company within that will have their own unique set of circumstances. So for instance, on the buy side, there's obviously a lot of companies seeing this as an opportunity that they can grow quite quickly and acquire businesses that are more available and ready to talk about being acquired than previously. And obviously there's better valuations on the table. So for some businesses, this is a really great time. Obviously on the sell side, again, it kind of depends where your business is and whether you've been able to pivot or benefit or just stay the same, I suppose, during this period, in which case now is as good a time as any if you've been on a fairly reasonable trajectory of growth or stability, then it's a good time to sell. If your business is experiencing lots of problems and it looks like you could run out of cash sometime in the near future, then again, it doesn't necessarily mean it's a bad time to sell. Obviously, the valuation of a business will change massively based on the current accounting period. But if your business is in trouble, what we talk about quite a lot with our clients on the buy side is how they're able to provide a safe harbor for smaller businesses. And that's really one of the things that they're looking to do as well. Obviously there's an opportunity for them, but they're looking to bring smaller businesses into their group and make sure that these businesses can survive and thrive in the future. And obviously there's a certain amount of a gamble there that they will invest, and hopefully the business will pop up out of the other side. So if your business is experiencing some problems, then and you're not sure how long you can go on for, say you've only got another 6 months or less of runway that you can see, then it's still a good time to start talking about acquisitions. But obviously you have to accept that there could be a variation in the price that you might have got if there wasn't a pandemic. And then the other thing is, I suppose, if you are a healthy business, or you are struggling a little bit, but you can see that you're going to be able to cut down all of your costs at this point, and kind of get out the other side, maybe into the middle of next year when maybe restrictions will lift and things are likely to pop back up, then I think the probably the most sensible route is to make sure that you get a good price for your business, is to batten down the hatches and get in survival mode and don't sell up. So yeah, I mean, there's lots of different variables, and every company is unique.
Okay, and when you talk about safe harbor, the safe harbor is obviously stronger if you have contracted customers. What about if you're actually operating with non-contracted customers, which some of the agencies that we work with don't have contracted, they're more on an ad hoc basis?
Yeah, so that doesn't it's not necessarily a negative. I mean, it's very good to have contracts in place, because obviously that gives you a pipeline of business that the acquiring company can rely on. But if that's not there, then it would probably still boil down to what kind of work you've been experiencing, what levels of work you've been experiencing. So what we look at when we're trying to value a business is the last 3 years. So we'll look at the profit margin or operating profit or EBITDA of the last 3 years, and we will be able to make a judgment call on the value of the business based on that. So if you've got regular work but no contracts over the last 3 years, then you know it's not just down to whether you have contracts or not. So I think, yeah, if you can show that you've got regular work, then the value is still maintained there. And I think the main thing when we speak to our acquiring clients is they're looking for a business that has good clients. So whether they're contracted or not, but just, you know, you can see from the quality of clients that they're working with that they're a good business because they're trusted by, you know, other good brands. And also we're looking for good people that are very able and people that, you know, do good work and have a good reputation for the quality of the work that they do. So, you know, it's sort of more generally, those are the sort of 3 things that buyers are looking for: is good clients, good people, and good work.
Okay. And apart from the obvious of having conversations, how do you know if an agency is up for a conversation of looking to sell or looking to acquire? And how do you know that they're a cultural fit as well? Because obviously that's important for customers, for staff, current staff, for business growth as well. But how, you know, the HBA, we're not an introduction service like a dating agency, but obviously we helped forge relationships or partnerships. But how would somebody know who would be interested in selling without obviously asking the direct question?
Yeah, so I mean, that's kind of where we come in to some degree. So our role is really to find businesses that are looking. I mean, quite often businesses will be sort of projecting an acquisitive mindset. Either they're marketing themselves as acquisitive, so they might have stuff on their website, or they may have, you know, hired a business like us that are going out and asking companies if they're interested in selling. But really, it's very difficult to know. What I would say is most larger businesses go through some cycle of acquisition. So you can sort of safely assume that a larger business should be or could be acquiring companies at any given point. And then what we actually do is I mean, our speciality is finding off-market buyers and sellers. So quite often we will approach larger agencies that are in a similar market or a market alongside in a slightly different vertical as our clients, and we will then brief them on the business that we have available, and, you know, get them excited about what the business does and how it matches and how it could fit, and, you know, double the size of the business if they were to acquire it. So part of what we do is also sort of a marketing service and getting those potential acquirers interested. But yeah, it's difficult to know without asking. What we, you know, our job is not particularly complicated, actually. It's just down to relationships a lot of the time. But how we start our search is we will collect a list of 100 or more potential businesses that have a match, and then our M&A guys, they will go through that, find all of the contact details, and then approach those businesses one-on-one and see if they're interested or not. So partially it's a numbers game as well. It's really, you know, if you were to do that yourself, it would be to get a big long list together of people who you think would be a good fit, and then to approach them all individually. And obviously the majority of those businesses are going to say no, or there's not a fit. But then you boil that down to the smaller group, and obviously then it's about, like you said, in terms of having a similar culture, then it boils down to chemistry at that point. And so if there's a chemistry, quite often the finances aren't the biggest issue, you know, whether they have the money or not, because you can always go and get the money if you like the fit. But it's really down, we are like a dating agency, unlike you guys. We're finding companies, or your job would be, if you were to look for it yourself, is to find companies that match, and then have those deeper conversations, look at the work that both sides do, and see if there's a good cultural fit between the two businesses. And actually, one of the things we see as well within that is quite often, even though the CEO on the acquiring side will quite often lead the conversation and have the first conversation, it tends to be then the creative, the creative director will take over and make sure there's more of a cultural fit, and the way that two companies work has a good fit. And at the end of the day, if there isn't a cultural fit, what you will see happen is that the finances will take the sort of most important thing within the deal, and the conversation will go forward, because say somebody's getting £1 million for their business and they're really happy about that. Actually, if there isn't a cultural fit, at some point the deal will fall apart, just because both sides, one of the sides will fall out. So actually, to save everybody the heartache of going through that and it fall apart, it's best to get the cultural thing there first, get the chemistry and make sure this is the right type of business for you to go into, or if you're on the acquiring side, for you to acquire this type of business, that it wouldn't disrupt the current business that you have as well, that it would fit and it would gel and work together.
Okay, and you talked earlier just about kind of business worth, and obviously some businesses are worth different, well, a lot of businesses are worth different than they were pre-COVID. What is the business multiplier an acquisitional business would be looking for, and what are the sellers looking for, particularly improving of the business being stable, viable, and as you mentioned earlier about evaluation, what are the key things that they really are looking for there?
So there's a very general model that we use in terms of valuing a business. So, and particularly, so we're in the service industry, and the majority of our clients, more or less 99%, are service businesses. They don't have very much in the way of IP or any sort of assets. They might have a computer or two and a desk and a chair, but they tend to not have very much aside to that. So the service industries get valued much more differently than say a tech business, for instance. And part of the issue, and this is something everybody kind of needs to get their head around, is the tech businesses are obviously the most prominent ones, and they're the ones that we read about in the newspapers. So a tech business, they could have a valuation of 10, 20, 30 or 100 times EBIT, or even sometimes they do multiples of turnover as well, multiples of revenue. But the reality is, for service businesses in particular, those multiples are much smaller. And there's a reason for that, and I can explain that. But generally speaking, if your business is smaller than, say, £1 million turnover, then the likely multiplier for a smaller business like that is 3 times EBITDA, or 3 times the operating profit of the business. So that's before tax is paid, before interest is paid, or before the accountant fiddles with the numbers to get the valuation down so you pay less tax. That's really where that EBITDA number sits. So for instance, if you were turning over something like 400 grand, your profit was 200, and then say you would take 100 out of the business for your own salary, or you would take that through dividends, and there was 100 grand left. So the value of the business would be something like 300,000. And then on the other side of that sort of million turnover point, up to about 5 million, a valuation of a business would be anywhere between 3 and 5 times multiple. So for instance, if you were doing 5 million in turnover and you had £1 million in profit, the valuation of that business is likely to be around 5 million. And then above a 5 million turnover that's profitable, obviously, you would start to get bigger valuations. A 15, 20 million turnover business that's profitable would likely be able to get something like 8, 9 or 10x multiple. But then you would look at other things. So if there's some of the agencies that we deal with, they do have platforms. So for instance, that's fairly common as well with conference businesses and venue finding, is they may well have some kind of IP in a digital platform that they've built. Then we could look at that as having its own value as well. So we'd work out the EBITDA multiple, and then we would add on any IP valuation as well. So that's roughly speaking how we would get a multiple. And then what tends to happen is the business then is paid for using what sometimes is called seller finance. So the buyer would give you 50% of that money up front, and then they would give you what's called an earnout over a 2 or 3, sometimes longer, sometimes even up to 5 years. They would give you like a fraction of the money that's left over a 2 or 3 year period for you to earn that out of the business. And the reason why that's done is just to make sure that the handover of the business goes smoothly, and that the acquirer doesn't take control of a business that then starts to lose value from day one. And this is particularly where it comes in with service businesses, because they pretty much always boil down to one or two, or maybe a few more, but they boil down to 1 or 2 founders being in the business, and they are the sort of linchpin of the business. They have most of the relationships, and that's why you kind of have those lower valuations, and also the sort of longer earnouts, where you would need to stay in the business for a certain amount of time. So that tends to be very generally how that works. There's obviously a million different ways that could actually happen in the end, and actually what we're seeing it during COVID is that 50% up front is now being reduced down to something like 30% up front, because the risk is now on the acquirer to give you a big stack of cash that everything, you know, it might not bounce back up soon enough for them to be able to keep the business alive. So they're offering a little bit less. But the other side of that is that they're offering higher valuations to pay once the business gets back to where it was as well. So, and there's always 2 sides to everything.
So that's like it's like a shopping list then, that you as you say, the upfront fee that they'll receive is reduced at the moment because of the risk, but actually the longer term that you'll keep part of that business is accentuated, and then potentially as the business picks up, you'll earn on the back of that if you were the seller. Is that correct?
Yeah, so what you could do, so I mean, this is again where it's good to work with an advisor, because we could come in with different model suggestions.
Sure.
But what you could do is you could have a lower valuation, but you would build in a revenue and sort of a bonus model that would give you some of the value in the business. So, you know, obviously right now the business might be worth a lot less, so that initial payment would be a lot less. But going forward, if it was to uptick back where it was, then what you would do is you would have, you know, sort of a performance related piece on top of that. So if you were to have low-ish targets, but you were to go over the top of those targets, then you would share a bonus. So if, you know, say the bonus was, or the payments were 200k every year for the next 3 years, but you were to hit actually 200%, then you could work out how to get to a 400k payment for those years when you've doubled expectations. So yeah, we would try and negotiate a model that would work, so you would benefit from the business growing back up to where.
So like a risk and reward model.
Yeah. I
And
mean, there's loads of. Sorry, go on.
No, you go on.
I was just going to say that there is, I mean, there's a ton of different variables as to how that could work, and quite often what we also see, and particularly I've been seeing this more in the events industry actually, is that the acquirer is willing to do what they call a cash and paper deal, and that means that they're happy to give you a lump of cash, but not all of the value of the business, and actually give you some equity in the top business as well. And that seems a little bit more common. I think it's more common in events because it's such a personality-led business, and you know, it's all about your network and being able to leverage your network. They actually 9 times out of 10, acquiring companies don't really want the founders to leave the business, so they would keep them in and keep them motivated to work and stay in the business by giving them that small piece of equity in the top company as well. So yeah, I mean, there's so many different ways that you can slice a deal up.
So you can basically provide different options for consideration, whether you are the acquirer or the seller. As if a business approaches you to acquire or to certainly to buy, you can then look at different options based upon what they're trying to achieve. So if they're trying to achieve, they need some cash now, you will then come up with a model that works that potentially can give them the different options to consider.
Yeah, I think that the fairest, the best model really for most companies that we deal with is that kind of mix between cash and equity, because you know, you spent a long time building up a business and it's your baby. And quite often, you know, the types of people that start businesses, they are almost unemployable in some ways. You know, we're the rebels, aren't we? We don't want to be employed by other people, and we don't want to be answering to a boss. Otherwise, why have we gone through the pain of setting up the business in the first place? And I think it solves that as well, because if you continue to be a stakeholder in the business and you can negotiate yourself a position on the board, then why not take a bit of that money off now? So you're cashing out for your hard-earned work, but also you get to stay in the business, you get it to still have meaning for you, and you get to be part of the management team, and that gives you also a pathway yourself as a career. And quite often as well, I find it quite a good offer, in fact, especially when we're dealing with PLCs, because if they offer a board seat to a business that they're acquiring, then that's quite exciting. You know, once you're on a board for a PLC, that opens up a whole other world for you of options, where you can then become a non-executive director for other smaller businesses and help them to sort of grow as well. So it gives you a lot of options to be able to sit on a board like that. But yeah, for me personally as well, you know, I don't want to really work and answer to a boss, and I think that's like a key thing for probably 80-90% of the people that have started businesses, that they really want to keep hold of a little bit of it themselves. So yeah.
Okay.
I don't know
And
if anybody in agreement.
I'm sure a lot of people are not. Just looking at costing models, and you know, in this industry, you know, from event management perspective or venue finding, they have very different costing models, where event management is more a statement of work, paid, you know, daily rates or shopping list of activities that they'll get paid for. Where you've got then venue finding, which is looking at commission on meetings that will take place, margins that sometimes are split between the customer and the agency. Where do you see that? And you know, with agencies, some agencies on here, you know, they will work on a commission model, and with meetings not taking place, or very small meetings, the commissions have gone, you know, completely down, if not completely dried up, or work that's been booked and you know, taking place, confirmed, but then cancels again. There's no money then through to the agencies. How do you see that if you are looking to sell your business? Because ultimately, that income or that margin that's due to come in may not come in, may be massively delayed, because that event now is not taking place till 2021, 2022. How does that impact in terms of if you're looking to sell your business?
Yeah, so of course it does have an impact at the moment. I think if businesses are pivoting, or they are able to have long-term relationships with clients, then they can possibly look at adjusting those business models so that they have either contracts in place or some kind of subscription model. But if that's impossible at this point, then potentially it will have some impact. But quite often, one of the things that we do with our clients, when we're finding a buyer and we're trying to sell the business, is go through their pipeline and try and get a value for what that pipeline looks like. So, you know, we will rate the likelihood of those events going forward, whether they will happen, and then what the value of those are, and then we can use that as some leverage for the value of the business, you know, going into an acquirer. And I mean, one of the main things for us is to be able to tell the story. You know, it's as well as this part of the business being a lot about you know, accountancy and going through the numbers and finance and all those sorts of things. The main role for me in the business really is to be able to tell the story of the company it's either buying or selling. So it's really to have a good story in place in terms of what is going to happen next. You know, of course, everybody's had a bad year, everybody has had it except, you know, maybe Amazon and a couple of other internet companies. So it's accepted by most acquiring companies that there are going to be some issues with this year. But it's really to be able to tell a story of how your business is going to grow out of the other side, you know, what is in the pipeline, what the relationship's like with those clients, how reliable have they been previously, and what's the likelihood of you being able to continue to grow the business as you have done in the previous years? Or have you been a very, very stable business for many years? And so the likelihood is that when business comes back to normal, that you would be able to continue at a level that, or somewhere close to the level that you've previously been able to demonstrate. So that's a big part of it, is to be able to tell a good story around the company as well.
Okay, you did touch on it then, just briefly, just about pivoting and business diversification, but what is the aspects of successful, sustainable success and providing that growth strategy? You talked about there, it's about the story, and at the moment for some of agencies, you know, as I mentioned earlier, they are, and you have gone into different ways of working and different you know, different approaches, and had to be able to accommodate customers but drive new customers and attract new customers as well, and some of it's for survival. But what is the kind of the really key things that we should be considering when looking at growth strategies and coming out of a pandemic?
Yeah, it's a good question, this one, quite a tough one to answer, because I think it's I think in a very general way, I think the strategy is to look at, if you're a smaller business, is to look at how you can grow what I call a 360-degree approach to business. So how can you tackle digital, for instance? So maybe at the moment, a lot of your work is very manual, you have lots of relationships, but digital is king now. And what's happened with COVID is it's accelerated that switch to digital. So the businesses that have been able to represent themselves well digitally are the ones that are going to succeed. And also, I think one of the other things that I've seen with events industry businesses in particular is how they've kind of repositioned themselves very much to be something that looks more like a communications agency than just a straight up events production company or something like that. So it's about how you can acquire those skills. Do you need to, I mean, not in 100% of circumstances would you want to go out and spend £1 million to buy a business and put yourself at that level of risk, because we don't know, the pandemic might be over in 6 months and everything goes back to normal. But certainly we're seeing our clients look at sort of virtual reality and video companies as an option for them to acquire. So is that a skill set that you can acquire easily? Is there a local business that you know has good people in it and maybe have struggled with video, and actually we could switch on a whole bunch of you know, virtual and hybrid events like we're doing today? So, and what does it take, you know, to do that? Obviously, even with this event itself, we've got you know, somebody controlling the video and the vision mixing and the audio and setting the stage up and all the other things that have come with this. Does it make sense for your business to acquire those skills and buy that in? Or even, are you able then to pivot and look at other ways of, you know, adding strings to your bow? Yeah, it's a tricky question to answer because it's fairly broad.
Yeah.
My personal feeling is that, and having seen it, is a lot of this is about mental fortitude. And, you know, obviously everybody's experiencing extra pressure, but it's like, how can you grow your own business and pivot? Or, well, pivot's probably an overused word, but how can you sort of take advantage of the situation? Is there things that you can do to capitalize on what's happening and create new opportunities for yourself? And we are seeing businesses pivot, and I think and it's important to be able to pivot, but it's not been the only thing that we've seen. We've also seen other businesses, in terms of like diversification, which are asking, is we've seen businesses really focus on a completely new set of skills that possibly were only a tiny fraction. So for instance, one of our clients, which is an events business, we are now acquiring a health and safety company in a slightly different sector to them, and we're going to bolt that onto their business, and that now gives them, they have some health and safety people working for them. Now they're going to have a much bigger health and safety business attached to their events business. So when, you know, events bounce back in the middle of next year, they will of course still have their events business, but they will also now have a very healthy health and safety business, which of course is only ever going to grow over the next 6 months as more people need COVID testing and, you know, distancing measures put into events, etc., etc. So, so that, you know, health and safety is completely, well, I don't know, maybe you guys would know more than this than I would, but health and safety seems to me like a very different business to go into than the events industry. But it makes absolute sense at this point to go into that. So
it does make sense. Yeah, I was gonna say, have you seen any more examples like that where, yeah, a health and safety business does feel very left field, but you can see why it also works? Are you seeing other events business or other creative industries, creative businesses looking at, you know, things like that as an example where you wouldn't have considered that probably before pandemic?
Yeah, I mean, we do have 2 clients on the buy side at the moment that are events businesses. So as I touched on before, obviously virtual reality and augmented reality and video companies have been the obvious ones, but they're very much looking at digital and digital comms as well, and how that works and how that fits into the events industry. One of the things that we're looking at quite a lot for a business that we're working with is social media and how social media plugs into events. And that might not be a particularly obvious fit for events and social media agencies to be able to join together and work successfully together. But it makes a lot of sense when you look at how events work. And certainly if going forward, we're switching to mixed reality events where you have a certain section of the audience actually there in the flesh, and you have other people attending virtually because it's become much more normal. And actually the value of selling tickets virtually is much better now. So to market those types of events, the social media aspect is much more important. So yeah, I'm probably thinking around that as well is, I suppose, anything that's in the supply chain. So you have what they call horizontal acquisitions and vertical acquisitions, and anything that's in the supply chain that you need is also a very sensible strategy. So if you pay a lot for, I don't know what you would pay for, but let's say presentations, because you're constantly pitching for work, then that supplier in your supply chain might be a good target for you to either acquire or to, you know, to hire people in to do that. Yeah, just off the top of my head, it's quite broad.
And in terms of mothballing businesses as well, you know, where you talked about earlier that, you know, you get a fee up front and then you work for a longer period to get get money back in if you're sitting on the board, etc. What about, you know, if you've got a customer base and appreciate that customers may not be spending in the way that they were spending before, though that customer spend may come back in another way or a different way, whether that's now more onto virtual, but you don't have the ability at the moment to display that actually this is what they're spending. Is it based on the fact of the historical what they've done in the past, even if you know for the future they may not go back to those levels? So I suppose what I'm saying is there ability for an agency to work with an agency to work, not acquire as a straight right with I'm selling my business to you, but more working in collaboration that you can take some cash up front, but actually as the business picks back up, you take that business back, but maybe at a lower rate?
We don't see that as an option very often. I would say that would possibly, if you're very confident that you're able to do that, probably the bank would be the best place to go for those types of lines. So there obviously is bounce back loans and CBILS loans in the market. But no, quite often the business wants to benefit from the investment and the risk to their capital by acquiring the business. They wouldn't offer for the company to sell it back. But in terms of mothballing, we did see an interesting situation right at the start of the year, actually. Well, just at the start of COVID, where one business, one of our clients, they acquired a company that was actually mothballed. So the founder just felt that COVID had pushed them over the limit. And so they stepped back from the business and actually just shut it down. went to company's house and asked for it to be closed down. And then the management team was acqui-hired, we call it, into our client's company. So they obviously stepped away from all of the responsibilities of running a business and being under the extra pressure of COVID. And they basically went straight into this different company. They took all of the clients with them, and obviously they were able to negotiate a very good salary for themselves. And this may be an option for some of the members here, because they were bringing their clients into that new business. So they got, I mean, it was a completely different set of circumstances, and the acquirer didn't pay any extra money to acquire the business, but obviously they committed to a good salary for that expertise to come into their company. So that could be an option. It's a very brave move, only because there's so much feelings involved in owning a company as well. But to be able to say, this isn't working, I'm going to stop before it gets me into trouble, and be able to step away from it and close a business and then do something else, is obviously a very difficult thing to do. But actually, in some circumstances, it's a very strong move and could be an option for some businesses that are about to get into trouble. The worst situation you're going to see yourself in is overextending some kind of debt, whether it's certainly not to like HMRC or something like that, because they tend to, I mean, that's like the cheapest loan you can get, they often say. But certainly if you were to owe money to creditors that were able to pursue you for it, and it's certainly any cash that you would owe to a bank that would be able to pursue you personally for, then at that point, or prior to that point, you would really need to ask yourself, is it worth taking that kind of risk with the family home or whatever, and look at mothballing, like you say, and then looking at another option.
Okay.
But yeah, I mean, it's about relationships in this industry, as we've already said. So being able to take those relationships into another business is obviously a very strong hand to play when negotiating.
Okay. Just with regards to, as I mentioned earlier, the HPA is not a dating site and that introduction, but we want to be here to support members. In terms of how you match, what is your fee structure? Just to be incredibly transparent, what does that look like, and how does it compare to other similar businesses? And that's me being really quite frank.
So the types of services that we offer are very similar to investment banks, and also very similar to what they would call a broker. So it's a little bit like an estate agent for businesses. So we kind of fall in between those two things. Quite often what you'll see is when you're trying to sell your business and you approach both brokers and investment banks, but I should imagine most people are too small to pay the fees for investment banks. But the brokers, what they'll do is they'll charge you a very large sum up front, something like even like £9,000 or £10,000 for them to then, they create something called an IM, which is, or we also create that, which is an information memorandum, which is basically a PowerPoint deck that shows how the business works. And then they will charge you an ongoing fee. But what we see with brokers fairly often, particularly the ones that are not specialists in any particular area, is they'll take that money, create the IM, and then they'll just send it out to a mailing list and put you up maybe on some business for sale websites. But how we work is we on the sales side, so how we work is we will take a monthly fee from day one. We do a minimum of a 3-month relationship to make sure that we're covered for all of our upfront costs, but that is factored into that first 3 months. And then we also take a 2.5% win fee. So if we sell the business, we take 2.5%. What we find is within the first 3 months, we will have a serious contender at the table. Most likely we'll have a serious contender. And it takes about 6 to 9 months, very realistically, to sell a business. You can sell much quicker, but the way that we work tends to be that way. So we charge monthly retainer, and then we have a success fee. So that success fee, all of the retainers that anybody's paid is up to that point get added up and then reduced. We reduce that success fee down. So it's a very even-handed approach, I find, much fairer than the majority of our competitors, in that we don't take excessive upfront fees and then a win fee additionally on top of it. It actually builds up to, it's almost like pay as you go. So that's how we work on that side. And then on the buy side, so again, the majority of our competitors, when they're positioning themselves to buy companies for their clients, is they actually charge a premium on closing a deal. What we've found is by adding that extra success fee into the buy side, it actually really muddies the waters, and it tends to divide us with the client, because the client feels that we're just trying to get the valuation of the business up. It doesn't make sense for us to buy a company as cheap as possible, because we would have smaller fees. So we actually work on a flat fee. The success for us is the success of our client. And so, yeah, again, it doesn't muddy the waters. It means we're able to actually go and get good deals for our clients, and we don't inflate the valuations of the target businesses. So, yeah, that's how we work.
Okay. Have you seen an increase or a decrease in businesses wanting to sell or acquire during this time compared to a normal year?
Yeah, so I have seen an increase of interest. Yeah, so on both sides, we're looking at a very interesting situation. If you're a buyer in this market, then there's a huge opportunity for you to acquire businesses that are extremely good, healthy businesses normally, but they're experiencing trouble because of something that's completely out of the normal. So buyers are recognizing that there's an opportunity. We can acquire companies for cheaper than normal, and get really good valuations. Not only that, but also there would be some companies, and we're seeing this quite often, that are brilliant businesses, and normally they wouldn't be interested in selling right now, but because of how nervous they are, or they're running out of cash, and they're looking for the safe harbor strategy, that they're actually having these conversations now. And normally they would be looking at this in 3 years' time or something. So we're definitely seeing that. And then on the sell side, we're seeing I think on the sell side, there's two types. There's obviously companies that are slightly distressed, and we don't really deal with those types of companies. So a couple of our clients are will be in trouble soon if we don't find them something, but we tend not to work with distressed businesses. But on the sell side, what we're seeing is companies thinking, we need to have this conversation now, even though we're not really interested in selling, but we need to find out what the market is doing, so it's worth it from a research sort of position. But also they're thinking, if it was to hit the fan in 3 to 6 months' time, then they don't want to be behind the curve. They want to know what the valuation of the business is, and to be having serious conversations with potential acquirers. And then if things do get worse, they would obviously then step up to that. So yes, we're seeing both sides much busier than usual, to the point that we've acquired more stuff in the last few months. So it's definitely something we're seeing.
But if somebody approaches you were talking there, just to understand their business worth and getting ready to sell, maybe they find they don't want to sell. You'll charge them the upfront, the 3 months, but then if they don't sell, what happens then?
Yeah, I mean, if they don't sell, then obviously we've covered our costs, and they're free to walk away. I mean, if they don't want to continue with it, yeah, I mean, it's a lot of upfront work for us. Like I said, we create at least a list of 100 and start contacting everybody, and it's a big job for us to sort of get to that point where we can say, here's 3 to 10 different companies that are really interested in speaking to you. That takes quite a lot of work to get to there. So yeah, that money is spent. But in terms of the risk, I mean, what we also do is we do what we call like a done with you service. So rather than us charging you for us to do all of the work, what we'll do is we'll work alongside you. It's a much lower fee. And we explain exactly how the process works on a weekly basis. We also help you build that initial list, and then we have a weekly catch-up call where we look at the strategy going forward, see what we've done the previous week, make sure that we're staying on track with how the process works, and then guide you through that process. Rather than us doing it all for you, we'll do it with you and make sure that you do it. It's not an overly complicated process. The biggest part of the expertise really is understanding the industry, and if you've got that, obviously you've got that yourself if it's your company, then that's probably the most difficult piece. Everything around that, you could hire a virtual assistant to do all of the approach for you if you wanted, and you could keep your costs right down. So yeah, we offer that cheaper service as well.
Okay. And then just finally, how, if anybody on here or any of our other agency members that wasn't able to join this call today, if they wanted to kind of get in touch with you, what is the call to action, please, in terms of
yes.
the approach?
So I've got a Calendly link which I can put up in the chat. So if anybody wants to cut and paste that into a browser, they can. So basically, we've got an open door. I'm happy to speak to anybody about where their situation is and give them some advice. So if you book yourself an appointment into my calendar, we can have a 15-minute, half an hour strategy discussion about where your business is at the moment, whether it makes sense to acquire or sell your business, or even if it's just a very general, how does the process work? I need to know more information. So the door's open for anybody to come and ask me as many questions as they want on a personal one-to-one basis. And then if there is a fit and it's going to work for both of us, then obviously we're happy to move that along and get to a point where we can work together. But that would be the initial thing, is let's have a chat. Very much like a doctor or a lawyer works. First 15 minutes are free. So yeah, and I'm very real situation for lots of people is that they've got almost like sleepless nights. Maybe they feel like they're in a lot of trouble and they really don't know what they should do next. I've been in business for 25 years and I'm really happy to help anybody who just needs to be able to clear their head and discuss what their options might be as well. So feel free to get in touch.
Okay, thank you, Andy. Juliet, are we able to send that link out as a follow-up from today's session, if that's okay, just to agencies that weren't able to join? Yeah, and also people, so save people scribbling down. The chat box has been very quiet, apart from Guy's Movember link to his growing moustache. Has anybody got actually any questions for Andy? Or, as Andy said, he is happy to do a first 15-minute free one-to-one chat. So rather than sharing it with a group, we can share the link as well. But I didn't know whether anybody had any questions now for Andy.
Andy, I've got a quick question for you. Given that we've got a lot of agencies are non-contracted clients, we're all in pretty much the same dire situation at the moment. Is there any mileage in more a cooperative approach with agencies coming together rather than trying to sell, where, quite frankly, all of our balance sheets have been decimated? But we've all believed that our businesses are sound, strong. We've still got customers that will book eventually. But I just wasn't sure what your thoughts on that were.
Yeah, actually, you should join our newsletter as well. That should be another call to action. So go to capitala.co and sign up on our newsletter. We actually discussed this in the newsletter this week. That's why I mentioned it. So yeah, one of the strategies that we are looking at with some of our clients as well, and with certain groups, is the roll-up strategy. And this works very well in businesses like this, where you see there are obviously some big mice industry businesses, but when you see a very fragmented business, it's actually a huge opportunity for somebody to take the lead on this approach. So if you take 5 or 10 businesses and roll them all together in a group, you reduce your costs. Is that what you mean? You reduce your costs at the back.
Yeah, absolutely. It just makes it, I think we've all got or had really good people working for us. And I think we can probably just, you're absolutely right. Things like, if we've got hotel booking teams, you could quite easily set up a central reservations type arrangement. servicing clients individually, and the same in terms of venue finding teams. It's the account management to make sure they don't wander that's the difficult bit, and I guess that's the skill set that we've got with our own individual customers. But yeah, you're absolutely right. That's why I was thinking is rolling it all together and then making it more attractive to a larger company.
So it's a huge opportunity right now. I think, as I was saying before, most people don't really want a boss, or they don't want to be working with loads of other people. But obviously, when you're subject to these kind of situations, it becomes obvious that actually it might be better for some businesses. But what we do see is agencies looking at these roll-ups as an option. It's always happened. It's not a new thing. But certainly the opportunity there is now for people to lead on these roll-up strategies. But it makes huge amount of sense. As you said, you can save tons of money, back office, financing, for instance, HR, and maybe teams that you can share across the group of businesses. The value of your business changes overnight. So as I was saying before, in the formula for a business is, if it's less than $1 million turnover is 3x. But once you start rolling those businesses up, if you get over $1 million, suddenly your businesses, and this is called arbitraging valuations. So your businesses become bigger. So the moment, say you have, I don't know how big, generally speaking, some of the members are, but say your businesses are 500K each, you roll 3 of those together, you're now 1.5 million business. So the valuation before was 1.5, now suddenly you're 2.5 million, just by joining those businesses together. So it's always made sense to roll businesses together. Agencies are actually a prime sort of place for this to happen anyway. But certainly during this, it makes sense for companies to come together and say, how can we do this? And so how you would do that is, say you took 5 different businesses, you would look at the profitability across the group, and you would use a formula that valued all of the businesses in exactly the same way. And then depending on what that final number is for everybody, their valuations, they would take a percentage of the equity that totaled up. But yeah, good question. It's definitely a good option right now.
Okay, and again, if people do contact you, you can see you'll have a list of our members, but you can see other people that are part of the membership as well.
Yeah, and it's one of the things that we do work on. So we're happy to work on roll-ups. Quite often, what can happen is if you have 5 big personalities like that it becomes difficult for one company. Somebody takes the lead and then it irks everybody else. So actually including somebody like us, what we do is we take a small percentage of the top company, and then we help do the roll up and either help the business back on its feet, or then we look to exit the business as a group, and we would take that small percentage as our payment as well. So I'm very interested in roll ups, and if anybody wanted to discuss that, again, yeah, the link is there.
Okay. Any other questions at all, please, from anybody?
I had a quick question.
Oh, you, sorry, I didn't see where it was. You, Julie.
Yeah, it's me. Sorry, I'll turn this way. I had a quick question. Goodwill. In the past, I've heard many comments with regards to goodwill. Do you take goodwill into account? How do you add it to the value, or is goodwill just, not anything you look at anymore or talk about anymore?
So it really depends on the size of the business, how we value them. More corporate businesses wouldn't particularly look at goodwill, but as you get smaller and smaller, it becomes something potentially you could talk about. It isn't really something that we would use in a formula, but certainly, very generally speaking, or if we had goodwill on the balance sheet for some reason, then we could look at that in terms of evaluation. But quite often, in a very general sense, yeah, we would look at how a business, flexes its network, and that goodwill would have a certain amount of value. I mean, there's a lot of emotion attached to buying businesses as well as selling them. Quite often, the buyers that we deal with are founders of the business themselves and very creative, and they, find something that they're really, really into and they really like, and so they're prone to overpay for something as well. So that sort of goodwill valuation can certainly play its part.
Thank you. More question for you, Julie. Obviously we're recording this session. Is this session able to be downloaded for us to share with everybody on here today and other members that weren't able to join as well?
Yes, it's all recorded. It will be slightly edited at the end of today and then emailed over to us, and we can do what we like with it, post it, put it on the website, etc.
Okay, thank you. Thank you, Andy. Massive thank you for that and your time on this call. And I can see that you've put your calendar in there, and we will also send that out as a follow-up with the recording of the session as well for anybody that does want to pursue conversations with you, Andy. Yeah, thank you very much for joining us for this session. Very useful, very informative. So thank you very much.
Yeah, my pleasure. Thank you very much for inviting me. And just on that link, it's not 15 minutes maximum, but you know, however long it takes, and multiple conversations, obviously, to get people where they need to be. But yeah, a pleasure. Thank you very much for inviting me, and I wish everybody good luck and see you soon.
Thanks, Andy.
Thanks, Andy.
Bye.
Our one live attendee is clapping. Thank you very much for your applause. Lee, thank you very much. That was very informative and very useful from Andy, so thank you.